Your hit on the stock exchange, it didn't work, my friend.
Leave us.
No, you stay here. I'm in charge.
Do you feel in charge?
Alright, today is Sunday, March 7th, and this is a post-market recap for the stock market activities during this week and an outlook for the upcoming week. Whiplash, whipsaw, whatever you want to call it. But it was a wild ride for the stock market this week. All in all, down big, specifically in the growth and the technology names. However, we've also seen certain sectors of the market outperforming significantly, such as energy, industrials, materials, financials, and of course, it all revolves around the theme of inflation. The Federal Reserve conducted the so-called greatest experiment in financial history, and this experiment has produced Frankenstein in the form of inflation. And now the Federal Reserve is in a tough spot between balancing out their so-called main mandate of reaching maximum employment versus propping up and maintaining the rally in the stock market. And here is what it comes down to. Remember, since the QE era, the market has become a cocaine addict. What is the cocaine? Fiscal and monetary liquidity, but specifically monetary liquidity. The market could care less about corporate earnings or bad economic data, pandemics, poverty, nuclear wars, asteroids hitting the planet. That doesn't matter for the stock market so long as the cocaine is still flowing, and the market wants more and more and more. But perhaps the cocaine era is coming to an end. And here is what the stock market wants. The market wants lower treasury yields so it can maintain the current rally in the stock market. Because if treasury yields rise higher, well, now the whole Tina argument, there is no alternative, that goes out of the window, because now you have an alternative in government bonds. Furthermore, the market wants more cocaine. It wants more and more from the Federal Reserve in terms of liquidity. But here's the problem that the Federal Reserve is facing right now. To get out of the deep hole from the pandemic, they decided to work in letting inflation rise higher. And they actually tried to psychologically play the game of pushing inflation expectations higher, because they believe that if they push inflation higher, that in turn will recover the employment picture in the economy. The problem, though, that all of this tsunami of liquidity has resulted in unwanted inflation, and inflation risen higher and sooner than the Federal Reserve expected. And now they are in a big dilemma, a very tough spot for the Federal Reserve to be in. They got two choices. Number one, to acknowledge inflation. And what they're going to do here is using their tools to manipulate the yield curve, whether using SLR or Operation Twist, or even increasing their bond purchasing program. Whatever tool they use, it won't matter. What matters is the end result of manipulating treasury yields lower. The problem with doing that, though, is two things. Number one, they went on a propaganda tour for over 2 weeks now, telling us that yields are rising for quote-unquote the right reasons, and we need not to panic about the rise in yields. Of course, that did not work. And the bond vigilantes continue to say, oh, wait a minute here, Mr. Jerome Powell. You think we're playing a game? You continue to deny inflation? Well, here is more. We're going to push those treasury yields to 2% because 1% didn't phase you. 1.5% did not phase you. How about we push it to 2%? Maybe you'll get the message when we push it all the way to 2%. The other problem with acknowledging inflation from the Federal Reserve's part is that there is no guarantee that this remedy will work for the long term. It could work in the short term, whether we're talking about yield curve control or any other measure. It could work in the short term, but the market will decide how to deal with it. And the market will say, wait a minute here. The Federal Reserve initially denied inflation, said it was not a problem, and yields are rising for the good reasons. All of a sudden, they're panicking and they're implementing yield curve control measures to push yields down. Perhaps the Federal Reserve is hiding something here about inflation, or perhaps they're worried and they're playing poker. They're not letting us know that in the public. So what will happen is that initially you'll see yields diving lower before the market pushing yields higher once again, and therefore acknowledging inflation from the Federal Reserve's part is a very risky strategy. The other choice is to continue to deny inflation, and this is what they've been doing on and on and on. And they do that by doing nothing and going on the propaganda tour they've been going on for weeks now. The problem with this approach is that if they do not address inflation expectations, yields will continue to surge higher and higher and higher, out of control, and that will cause a crash in the stock market. So it's a lose-lose situation here for the Federal Reserve. And how we got here is due to the quote-unquote greatest experiment in financial history, which created Frankenstein. And by the way, what happens from all of this environment in the stock market? Well, number one, financial stocks will benefit tremendously because the yield curve will continue to steepen. Likewise, value names, inflationary names will trade higher. Meanwhile, growth stocks, technology stocks, the future bro kind of stocks, these are the stocks that will get hammered significantly. And you can see the correlation between the movement in the triple Qs, the NASDAQ, and Treasury yields. And by the way, a lot of people are confused, specifically newer investors. Wait a minute here. Technology is the future, bro. Why would it go down if yields are going to rise higher and we are seeing a recovery in the economy? Well, the future, bro, is exactly the problem with technology and growth names. I addressed this point before by explaining to you that future earnings get diluted when Treasury yields and interest rates in general rise higher. But here's an explanation from the Financial Times. Low interest rates can temporarily justify higher stock prices because they make the existing and future earnings of companies more valuable. At an interest rate of 5%, you need $20 million to earn $1 million a year, while at an interest rate of 1%, you need $100 million. Therefore, $1 million a year in corporate earnings is correspondingly more precious when interest rates fall. One worrying message of high stock prices, therefore, is the markets expect low growth and low interest rates for the foreseeable future. When you negate this theory by interest rates and yields surging higher, all of a sudden, those future earnings are not going to look very attractive, and the market shifts from appreciating growth stocks to appreciating value stocks instead. On Friday, we also received the jobs report, and it was better than expected. Matter of fact, the headline reads, "Jobs growth surges in February above expectations," further contributing to the steepening of the yield curve and inflation expectations. And I issued this tweet right away. Good jobs report equal Fed will end the cocaine operation sooner equals the market throwing a fit. And you saw that happen right away before we saw dip buying and short covering, rescuing the market and pushing it higher. We will discuss the market action and a lot more. The jobs report, the Fed's reaction, market sentiment, corporate specific news. We will address the heat map and the market themes, the inflationary trade, the rotation trade, and a lot of charts to try to decode what the market will do next. We don't need to waste any more time hyping up the show. You know it's going to be good, so buckle up your seatbelts and here we go. The Dow Industrial Average closing in the green by 572.16 points, or a gain of 1.85 percent. The Nasdaq also closing in the green by 196.68 points, or a gain of 1.55%. The S&P 500 also in the green by 73.47 points, or a gain of 1.95%. And what about the sector's performance? On Friday, every single sector in the market managed to close in the green, led by number 1, capturing the gold medal, energy, at number 2, capturing the silver, industrials, and at number 3 for the bronze, materials. Meanwhile, the laggards of the day, if you can call them that, consumer cyclicals, real estate, and utilities. Now let's contrast this performance with what we saw throughout the week. At number 1, and capturing the gold medal by far, energy. At number 2 for the silver, financial. At number 3 for the bronze, industrials. So once again, you are seeing an outperformance from the inflationary trade, the inflationary sectors of the market. Meanwhile, you're seeing underperformance and lagging from the deflationary sectors of the market. Moving on to the futures market performance on Friday. Once again, massive gains for crude oil. Brent is already closing at $70 a barrel. Who would have thought that a year ago? But here is inflation right in front of you. You don't need to make it up. Meanwhile, the Federal Reserve continues to pretend that there is no inflation. And by the way, we're already starting to hear about crude oil 100. And once that becomes a psychological goal to reach, traders will push crude oil prices higher and higher and higher until perhaps, indeed, we will reach $100 a barrel. And there is more reasoning behind it. Here it is. In a bold taunt, Saudis warn America's frackers, drill baby drill is gone forever. And by the way, pay attention here, because this is very important for you if you are considering investing in the energy sector. Which names should you pick? If the prince is right, OPEC Plus will be able to both push prices higher now and recover market share later without worrying that rivals in Texas, Oklahoma, and North Dakota will flood the market. But if Riyadh has miscalculated, and it did that before, by the way, the danger will be lower prices and production down the line. The Saudis have so far convinced their allies the strategy will work. After a quick virtual meeting on Thursday, OPEC Plus agreed to prolong its production cuts, defying expectations of an output hike. Russia, however, secured an exemption for itself and Kazakhstan and will increase output marginally in April. What does that mean? First of all, the Saudis tried this strategy before and they failed because drill baby drill and fracking in the US was white hot and it caused tsunami of supply in the oil market. Now it is different though, and the strategy might work for the Saudis, the Russians, and OPEC in general. And the strategy will work because the Joe Biden administration is anti-fracking, meaning that the concerns that fracking will resume in America when we see higher prices is not a concern at all. In addition, higher yields will pretty much bankrupt all of these frackers once and for all. Why is that? Because during the drill baby drill era, investors in these fracking companies did not care about profits. Right now, they cared about gaining market share and increasing volume. And therefore, these fracking companies became zombie companies. They took an enormous amount of debt. And now, as yields start to surge higher and higher, it will be extremely expensive for them to maintain the interest payments. So if it all works according to plan, those frackers will go bankrupt and oil prices will continue to surge higher because they don't have to worry about the supply coming back from the US shale producers. And the only obstacle remains the Russian output because Saudi Arabia is interested in higher prices. The higher the price, the better for Saudi Arabia because they know that this is their last chance to diversify away from oil. So they want the highest price possible. They want to exploit the moment of the weakness in shale producers. The Russians, on the other hand, are interested in market share, not pushing the price higher. This is good enough for them, and they want to resume flooding the market with oil. So once again, what do you do in this situation as an energy investor? Number one, the peak could be very near here as the market starts to expect the increase of output from the Russians. Number two, when you pick an oil company to invest in, make sure that this is a large international producer. Stick with the big ones. Exxon, Chevron, British Petroleum, Conoco, etc. But also make sure that the balance sheets are as good as they can be. We know that they're heavily burdened with debt, but try to pick up the best balance sheets out there. Avoid investing in any shale or sand exploration, fracking producers, because these are the names that will get buried alive if we continue to see yields surging higher. What is my strategy, by the way? I did buy both the Russian and the Saudi ETFs. The Russian ETF is RSX, the ticker, and the ticker for the Saudi ETF is KSA. And I do believe that Aramco will outperform significantly under this inflationary environment, and therefore that will benefit the Saudi economy. Likewise, the Russian economy will benefit from this environment as well. From the rise of both energy and materials prices, Russia is known for producing both. And therefore, I invested in both ETFs, the RSX and the KSA. And I do believe that these two economies will outperform during the inflationary environment. Back to the futures market, what do we see here in softs? Declines led by coffee and cocoa futures. Meanwhile, lumber back at it again, surging higher. Likewise, we saw sugar and cotton futures closing in the green. What about metals? The rally in copper goes on. It doesn't matter what kind of manipulation you're going to do with the US dollar. Copper is going higher because the demand is so hot, specifically from China, and the supply is very limited. Meanwhile, we saw some pressure here for gold, silver, platinum, and palladium Futures. Copper remains the outperformer in metals futures not just on Friday, but for months now. What about meats? What do we see here? Muted activities across the board with modest gains for live and feeder cattle. What about grains? A resumption for the gains for grains. Whether we're talking about soybeans, soybean meal, soybean oil, corn, oats, all closing with massive gains for the session, further contributing to the inflationary picture. Meanwhile, we saw declines here, modest declines, for rough rice and canola futures. Moving on to the big casino, the options market. Let's see what happened on Friday. There's a lot of fear going on in the market, and we're seeing options volumes actually trending lower, not higher. And there is a reason for that. A lot of amateur traders who've been buying call options, putting their blindfolds on, and buying call options randomly got burned badly the last couple of weeks. So there is some fear going on in the options market, and perhaps a lot of traders are already all in the market and they lost significant amount of money, and they are waiting for the new STEMI checks to use as ammo to resume buying call options once again. But for now, let's see what happened on Friday. Leading the pack and closing at number 1, Apple, with about 1 million contracts exchanging hands on Friday. About 68% of those were calls. And at number 2, Neo. Neo got whacked significantly this week, and perhaps there is a bounce coming. At least this is what the options market is saying. Neo closing at number 2 with a little over 570,000 contracts. About 62% of those were calls. And at number 3, Tesla, with a little over 500,000 contracts. About 51.5% of those were calls. We saw some bullish bits here, specifically for semiconductor names. I did play the rebound expectations on Friday by buying some call options in certain names, specifically the semiconductor names. I will show you exactly what I did during the charts analysis. But for now, moving on to the unusual activities that took place in the options market on Friday. Here's an interesting trade for the SPY, the S&P 500, and somebody's making a bearish bid here, buying the 360 puts, expiration date April 16th. With expectations that the SPY would decline over 6% by then, and they paid about $4.70 a piece to enter this trade, bringing the total to about $25 million. And indeed, when we look at the charts, you will see that in the short term, we could see some bounces, specifically in the oversold names, in the growth sector of the market. But when we look at the weekly chart, the picture starts to look different. It looks like that we just started the corrective action and there is more pain to come. What about this trade for the IWM, the small caps ETF? Another bearish bet, buying the 206 puts, expiration date April 16th, with expectations that the IWM will decline over 5% by then, and they paid about $5.50 a piece to enter this trade, bringing the total to about $20 million. So massive bets here for a downside in the market. Some of these are insurance policies, but the hedge funds are not going to initiate these insurance policies unless they do believe firmly that the correction will intensify in the next few weeks. And here is an illustration for you about the contrast between the medium to long term, which is bearish, versus the shorter term, in which we could see rebounds in the very oversold names that got hit significantly the last couple of weeks. The ticker IPOE. This is for SPAC Jesus, Shamath Palate Potato Tequila, who's been scamming young investors since the very beginning. And of course, this specific ticker got whacked significantly the last couple of weeks, but perhaps there's a rebound coming. We saw the name rebounding over 10% on Friday, but somebody's betting that the rebound has more room to go. By buying the 20 calls, expiration date March 19th, with expectations that the name will gain over 13% by then, and they paid about 85 cents a piece to enter this trade, bringing the total to about $2 million. Here's another one, the same theme. You're seeing the long-term bets being bearish, but the shorter-term bets bullish. For Apple, the ticker AAPL, and they are buying the 130 calls, expiration date March 19th, with expectations that Apple will gain over 7% by then, and they paid about 70 cents a piece to enter this trade, which brought the total all the way to about $1.5 million. Here's another interesting trade for GM, General Motors. They're making a bullish bid here, buying the 60 calls, expiration date April 16th, with expectations that GM will gain over 11.5% by then, and they paid about $1.44 a piece to enter this trade, bringing the total to about $3 million. And here's the last trade I want to share with you for American Airlines, the ticker AAL. And I happen to agree with this trade, by the way, because somebody's making a bearish bet here, buying the 18 puts expiration date April 16th, with expectations that American Airlines will decline over 12% by then, and they paid about 85 cents a piece to enter this trade, bringing the total to about $2 million. Why do I agree with this trade? I think that the so-called reopening names ran out of whack, way ahead of themselves, and the valuations are becoming insane at these levels. So I expect a pullback, at least in the beginning of the week, for the so-called reopening trade, and I do see a rebound and some gains for the stay-at-home, tech, growthy names that got hit significantly the last couple of weeks. Furthermore, the rise in crude oil prices at some point has to be considered by all of these investors and traders buying airlines and cruises stocks. This could be a double whammy for the airlines. They're just recovering from the pandemic, and they're about to hit with high oil prices right out of the door. Moving on to the headlines that shape the day, starting with macro news. And right away, we received the jobs report for last month. And let's see how we did. Better than expected, the non-farm payrolls up 379,000. Meanwhile, the unemployment rate at 6.2%. And we know that this is a fugazi number because the Federal Reserve Chairman himself and the Treasury Secretary, by the way, acknowledged that the real unemployment rate is probably higher than 10%. But anyways, this is the number we received, and it was not received well by the market. Why is that? As I told you, if the number is better than expected, that will contribute to more inflationary expectations, which will push yields higher, and you will see the market, specifically the Nasdaq, diving lower. And this is exactly what happened right away. But back to the details of the jobs report. Leisure hospitality had massive 355,000 gain in February, but level is still below recent November peak, and we are 3.45 million jobs below pre-pandemic levels. So the bulk of the recovery came from where? Leisure and hospitality. And the reason is not because more fiscal and monetary liquidity, but because of the reopenings that took place across various states. Once again, the virus is in control of the unemployment picture. But the Federal Reserve believes that if they throw more money at the problem and print trillions and trillions more, magically that will recover the employment picture in America. And that is absolutely not true. The more spending the Federal Reserve and the federal government is going to do, and by the way, we have another $1.9 trillion about to flood the financial system. And all of what that's going to achieve is higher and higher inflation expectations. And that would not necessarily correlate with a recovery in unemployment. And this is exactly what's going on. More spending, higher inflation expectations, higher yields, higher interest rates, and now it's starting to spill into the interest rates that actually impact the economy and the consumer directly. Here it is. U.S. mortgage rates have jumped above 3% for the first time since July, now at 3.2% versus 2.97% last week, and a record low of 2.65% in early January. And here is perhaps the first signal of the popping of the housing bubble. For Freddie Mac, impact on purchases demand has been noticeable. Activity has cooled and is on par with early March 2020. So the higher mortgage rate is discouraging some home buying. The problem is we're not seeing lumber prices corresponding with trading lower. They're actually trading higher, meaning that perhaps we will see another stampede in the housing market once home buyers, or potential home buyers in this case, realize that home prices will continue to go higher along with mortgage rates. And they better stampede right now and buy homes before they get more expensive to acquire. And that will contribute to round number 2 of the housing bubble before the whole thing comes down crashing. And by the way, let's address the question here. There are new investors who are baffled by all of this quote-unquote hysteria in the market, all because yields reached 1.5%? What is the big deal here? And you're seeing the same narrative floated by quote-unquote experts on CNBC, Bloomberg, and the likes, saying the 1.5 is not a big deal. And we were at 2% before the pandemic started, so what is the big deal here? I'll tell you what the big deal is. Go back to 2018, when the Federal Reserve started raising rates. The market did not like the interest rate hikes, but it tolerated it to a certain extent until yields reached the magic number of 2.25%. And then you saw the market crashing down, at least in the Nasdaq's case, of over 20% rapidly before recovering higher once again as soon as the Federal Reserve announced that they will not be raising rates any longer. Why is that, by the way? Because remember, back in 2018, we had a hot economy. Taxes went lower, unemployment was crashing down, we were reaching maximum employment. So why did the market throw a fit in the middle of all of that positive economic environment? The answer is because the market is, say it with me, a cocaine addict. The market cares not about how good the economy is. Matter of fact, the market hates good economy and thrives under a bad economy, because under a bad economy, the Federal Reserve and the federal government will usher the tsunami of liquidity. Under a good economy, on the contrary, the fiscal and monetary side will have to tighten the cocaine operation, and the market suddenly throws a fit. And here is why, this time around, it is worse than 2018 in terms of the risk of high yields for the market. Why is that? Here's one thing to consider: the steepening of the yield curve. Back in 2018, we saw just a modest bounce higher, and that was enough to rattle the market. And right away, we saw the Nasdaq losing over 20% in a matter of weeks. But right now, the curve has steepened in a manner that we have not seen since 2007. Furthermore, take a look at this chart with the correlation between the 10-year Treasury constant maturity minus 2-year Treasury constant maturity. That is in blue versus the S&P 500 in red. And here are some important takes. I want you to spot the difference between the start of the chart all the way to 2020 and then the period highlighted in yellow. What is the difference here? The trajectory for the 10-year Treasury constant maturity was lower, even though we saw spikes higher, and those spikes rattled the market during that period. But now we're seeing a regime change where the 10-year constant maturity minus the 2-year Treasury constant maturity is actually curling higher. The blue line in the chart curling higher, which is suggesting a change in the regime when it comes to the bond market. And the stock market did not take the memo. Continued to rally higher and higher and higher, but now we are reaching a point where the crossover is imminent. Take a look at the chart, 2018. Now, what happened when the blue line started to curl upward and trade higher than the red line? We saw a massive correction in the stock market. Well, now we're seeing a change in the theme altogether. It wasn't just a trend downward and a spike higher that came in 2018 and went away. This time around, it is a change altogether in the theme entirely. So once again, for all of the skeptics who continue to say, oh, the trajectory for yields are lower and inflation is not a concern, and what is the big deal about 1.5? Well, here is an explanation for you. The 1.5 today is worse for the market than 2.25 was back in 2018. And here is more. Remember the whole TINA argument? Well, that TINA argument just went out of the window because the 10-year Treasury yield is now yielding higher than the dividend yield of the S&P 500. Now, once again, you could be asking the question, what is the big deal? The 10-year Treasury yield pretty much always yielded higher than the S&P 500 dividend yield. But the trend was lower. The trend for Treasury yields was lower, and the trend for the S&P 500 dividend yield was higher. Now we're seeing a change in the regime, a change in the theme altogether, where yields are starting to curl higher, meaning that perhaps yields bottom and the trajectory from here on is higher. And this is why the route that we're seeing in the market right now in 2021 regarding the rise of yields and inflation expectations is way, way worse than the route we saw in 2018. In 2018, the long-term trajectory for yields was still going lower, and the deflationary pressures were in charge. We did not see inflation whatsoever. Now, things are changing. So if you thought that 2.25% in the 10-year treasuries rattled the market in 2018, watch what will happen if yields reach 2.25% in these market conditions in 2021. 20% declines will look like nothing. Here is more, the difference between 21 and 18. The forward PE ratios for the S&P 500, whether we're talking about large caps, mid caps, small caps, and we're talking about forward PE ratios, not even the lagging PE, forward PE ratios, reading pretty much all-time highs. And therefore, 1.5% in 2021 should actually have more impact, negative impact that is, on the market than 2.25% did in 2018. Can you imagine what will happen to the market if we reach 2% or 2.25% rapidly while the market is trading at all-time highs valuations? You gotta be crazy to still believe that the market is gonna go higher, specifically for the growth and momentum names, absent of the Federal Reserve doing something. And even if they do something, remember what I said before, it's a game of musical chairs. You can extend the music to go longer, but the longer you extend the music, the fewer chairs gonna be available when the music finally stops. And it will stop, it's inevitable. And here is more about the difference between 2021 and 2018. What about how leveraged the government is? And not just the government, but corporations. It's day and night between 2021 and 2018. If the US government's interest cost rise just 1 percentage point above the baseline, $9.7 trillion would be added to the deficit from 2021 to 2030, more than 10 times the annual defense budget. This is the so-called quote-unquote greatest experiment in financial history. Now the chicken is coming home to roost, and the Fed is panicking because the rise in yields and the rise of interest rates will completely destroy zombie companies and even the federal government. So on one hand, they want inflation to continue to rise higher because they believe that full employment will be achieved if we let inflation rise higher. On the other hand, they don't want the rise of inflation to be accompanied by the rise in yields and interest rates. You can't have both. You can't have your cake and eat it too, Mr. Powell. Choose one of the two. Either you're going to save the market or you're going to save the economy. And once again, I said in a previous video, if the Federal Reserve wants to save the economy, it has to sacrifice the bull market, kill the bull. The problem is, if you kill the bull, and we see a big, unexpected crash in the market that could spill over into the broader economy. So the Federal Reserve here is playing with fire. And why are they playing with fire, by the way? To begin with, because the genius that is Jerome Powell told you in the beginning, last year, once they started this whole change in regime regarding inflation, when asked about what is the exit strategy or what is the formula here, Mr. Powell, to measure inflation? He said, we don't have a formula. We're just going to eyeball it. You know what happens when you eyeball an ingredient and the meal comes out too salty? Well, Jerome Powell says, don't worry about it. I got the tools to fix that. I'll just splash a little vinegar on your meal and it's not going to be salty anymore. The problem is now it's too acidic. Listen to the genius, Jerome Powell.
Federal Reserve Chairman Jerome Powell laid out an aggressive new strategy Thursday aimed at getting millions of Americans back to work by agreeing to sometimes let the economy run hotter than the Fed's 2% inflation target before tapping on the brakes with rate hikes. In effect, the Fed is shifting from a hard inflation target to a soft one, in another unprecedented step to prove the age of easy money is here to stay for as long as necessary.
We're not tying ourselves to a particular mathematical formula that defines the average. Thus, our approach could be viewed as a flexible form of average inflation targeting. Our decisions about appropriate monetary policy will continue to reflect a broad array of considerations and will not be dictated by any formula.
And of course, this quote-unquote great experiment that's been going on for years, but Jerome put it in overdrive, has produced a monster, a Frankenstein, called inflation. And I love this piece from Fox Business because they did not hold back. They just called it like it is. So let's take a listen.
Folks, I told you every single day this week, this was going to be the moment I was waiting for, the moment the markets are waiting for. Remember, since that bond yield debacle last week, the stock market has been worried about this. Now, coming into the day, there was a litany of things that investors wanted to hear from Jerome Powell. Maybe an extension of the exclusion of the SLR, maybe an announcement of Operation Twist. How about possibly yield caps, or just working to find a way to convince investors that $1.9 trillion would not necessarily move the inflation needle? On the other hand, some economists and market watchers were even worried that anything the Fed chairman said that strayed away from the hymn sheet that he's been singing from would spook investors. Well, he didn't stray away from it at all. Either way, it's clear that this grand experiment at the Federal Reserve is running into problems. Some foretold, some we're not really sure we knew what they were going to be. So for more on what Powell's problems will be going forward, let's bring in Quill Intelligence CEO Danielle DiMartino Booth, along with Walzer Wealth Management President Rebecca Walzer. Danielle, so are you happy with what he had to? I just thought he was so. Check this out. When they asked about the yields, spike in yields, he said, yeah, it was notable. Notable? I mean, that's an understatement. I just think the dude is too cool.
He had serious foot and mouth syndrome today, Charles. He used the word disorderly. I think he's going to regret using the word disorderly because that's exactly what he's got. He said he wanted to avoid tightening financial conditions. Well, they're a heck of a lot tighter since he opened his mouth. And there was indeed an opportunity. Right now, the spread between long maturity Treasury rates and short maturity Treasury rates, it's similar to where it was the last time the Federal Reserve launched an Operation Twist. Call it Operation Twist 1.0. This would solve both of his problems with one fell swoop. He could get short rates up, which he needs to do, and pull the long rates down. This was his great opportunity to bring this subject up, and he did not.
And the reason why he did not, because the genius that he is, he already opened his mouth and stuck his foot deep in his throat by saying, oh, yields are rising for the quote-unquote good reasons, and we need not to worry about inflation. Inflation is just going to be transitory. Well, now when you launch Operation Twist, after saying that, the market's going to panic. They're going to question whether the Federal Reserve is hiding something and whether the Federal Reserve has actually lost control over the bond market. Jerome is in tough spot. Continuing.
Rebecca?
I agree 100%, although I do have to say I'm super excited about your Casey at the bat. You hearken me back to middle school with that. So I was like, yes, Charles, thank you for that bright moment in my day. I totally agree with Danielle. In his speech, he said, the last week had his attention. That's what he basically said. It had his attention. I guess I'd have to say that I'm glad that he did say he won't let market conditions tighten too broadly. But really, if you think about it, Charles, we're about to go into a blackout period on Saturday where they won't talk again until the FOMC, March 16th and 17th at the next meeting. So if we don't hear something else officially before then, we're not going to hear anything until, and I am 100% in agreement with you. We expected to get something, maybe not necessarily in this forum because it was a Wall Street Journal event, but something.
Yeah, he could have done something. Obviously, Operation Twist to announce it now, but to allude to it, that's all. Wall Street can connect the dots. Instead, it's pretty clear the Fed's created a Frankenstein's monster.
Boom. Did you hear it? Frankenstein monster. Even the media is now catching up to what we've been saying in this channel all along.
And this has happened over the years, right? For the most part, they've always bowed to the taper tantrums of investors. So you got to wonder at some point, Chairman Powell's going to have to pacify them as the market keeps going down and yields keep going up. Rebecca, what's the new magical number where this does more than just look notable to Chairman Powell on the 10-year? Would it be 1.7, 1.75, 2%? I mean, where does the Fed think now maybe they have to take emergency action?
That's a great question. The question is, Charles, the problem is it's the unsolvable equation. It's exactly what Danielle said. We have a situation where we're at the same time trying to stimulate our way out of what would be a Great Depression. I've got to say it because we're so shut down. And yet we're reopening. So he knows that the economy is going to start coming back with jobs, with labor increases. And he's still at the same time trying to maintain stimulation and at the same time not have inflation.
AKA, he wants his cake and he wants to eat it too. And back to the intro of this video. The market wants what? More cocaine, more stimulation, and lower yields. The market will be lucky if it gets one of those. And right now, it is getting more cocaine. Meanwhile, yields are rising higher. But soon enough, as the economy starts to recover, even the cocaine operation will have to come to an abrupt end. That's not going to be very good for the stock market. So if you're buying the dip, expecting another V-shaped recovery, you will get slaughtered like the sheep you are. It's one thing buying the dip to play a trade, a bounce, versus actually believing the stock market will recover higher in a V-shaped recovery like nothing happened. And of course, I'm talking to the Robin Hoodiots, the SPAC generation of investors who invaded the market last year during the March bottom, who believe that stocks only go up and there are no red days, and if there are red days, there are opportunity to buy. Put your blindfold on and buy, buy, buy. Ask questions later. Matter of fact, don't ask questions at all. These morons are going to get slaughtered because we have a regime change in the market taking place. They're not even aware of what's going on. Continuing.
This is a mathematical impossibility that has to get resolved somehow because it's really going to continue to freak out the market.
So Danielle, how does the Fed model out risk and assign importance, right? What matters most to them? They've got their official mandates, and then they've got so many other things that they're trying to achieve. Chairman Powell said it was not appropriate to isolate on one particular interest rate or price. Well, what's going to get their attention most?
I think what's going to get their attention is if you look and see what's been moving along with the rise in interest rates we've seen is we really have started to see corporate bonds fall out of bed. And I can promise you that given how much credit creation the Fed has facilitated with its low interest rate policy, it is paying attention to what is happening in the credit markets because they feed directly back through into the stock market. It's a terrible cycle that can get going. But I promise you this much. He may have fumbled today, but the Fed will change its policy if the wheels truly come off. I promise you that. The Fed will pivot. He's pivoted before and he will pivot again, but he really is making an error right now in judgment.
And of course, because Jerome is a confused pussy. He talked big and tough, saying that he wants inflation higher, and he doesn't need a formula, and he's not worried about inflation, and yields are rising for the good reasons. But if the market starts to crumble and his overlords from Wall Street start calling, he's gonna panic and do something. The problem is, will the market believes that the Federal Reserve and Jerome are back in control, or will the market believes that Jerome has lost control over the bonds market? And if that is the belief, it wouldn't matter what the Federal Reserve does. It's over.
Right. And to that point, Rebecca, some are saying, why even panic right now? Guggenheim, in fact, put out a chart showing that the 10-year is still in this long range, right? It's been range bound that suggests it could actually trough next year at 0.5%, so that it would pull all the way back if we could just be cool through this rough air pocket or so. What are your thoughts on that?
And this is part of the Fed's propaganda, Guggenheim releasing this bullshit chart, trying to convince us that yields are going to go lower. Are you kidding me? Even a baby, a toddler, realizes that yields are not going to go lower anytime soon. It's quite laughable, really, if it wasn't sad.
I don't know the modeling that they would come up with that we would actually decline with all the stimulus that's still projected, another 1.9 coming, that we haven't even spent all of it yet. So how in the world they have a projection of that it would be at the lower bound of the range at 0.5% is beyond me. It's not in any economic calculation I agree with, and I disagree. I think we are going to see inflationary pressure as we reopen and we continue to stimulate, and unless we have a sea change of what they're doing, as Danielle said that he would actually do, then I don't see us anywhere near 0.5%. No way.
Yeah, he's going to definitely go back and look at this, and I agree 100% with both of you ladies that the Fed's probably going to do something sooner rather than later, particularly after this performance. They've created a beast, and they've got to control it.
And bingo, yields are rising higher even without the new 1.9 trillion in new cocaine, which is about to hit the market very soon. Can you imagine what's going to happen after an additional 1.9 trillion hits the market? And they're saying, oh, the Federal Reserve is going to have to do something about it. Be careful trusting Jerome and the Federal Reserve. They've already stabbed you once in the back, and they'll stab you again because the narrative has changed. They just told us the yields are rising for the good reasons, and we need not to panic about inflation because inflation is transitory. Now, when the Federal Reserve panics and starts taking certain measures such as yield curve control or Operation Twist, what kind of message are you sending to the market? You're sending a message that you are shitting your pants and you're trying to manipulate yields lower, and the market eventually will take control and will push yields higher once again because they will read through the bullshit coming out of the Federal Reserve. And you see all these morons, the deflation crowd, the inflation deniers. Oh, but there is no inflation. Here is inflation.
If you're looking for signs of inflation. Head to the auto lot. Phil LeBeau joins us now with a look at what is driving car prices higher. Hi, Phil.
Hey, Joe, raw material costs, that's what it's all about. And we wanted to see exactly what raw material costs are doing to the price of automobiles in terms of what the automakers are dealing with. Check out this chart. This is due, according to data from Alex Partners, a consulting firm just outside of Detroit, works with the auto industry. We are at an all-time high in terms of raw material costs, up $1,152 compared to the averages of last year, now at almost $3,000 per vehicle in terms of raw material costs. And when you break it down, some of those raw materials, they have just exploded in the last year. Platinum metals, mainly we're talking about rhodium, up 135%. Steel has doubled in price. Copper, aluminum, they're all shooting higher. In fact, we found maybe one or two raw materials that are at the same price or slightly lower. Everything else is up, and that's done this to the auto stocks. Not a whole lot. Why? Because they're all trading higher on the expectations of developing electric vehicles. But make no mistake, it is weighing on their margins. Earlier this week, we heard from Stellantis CEO Carlos Tavares. He called raw material costs one of the great obstacles they're facing. They are able to pass some of this along to the consumer. Look at this auto loan data report. Fourth quarter, record highs in terms of how much people are borrowing to take out an auto loan, up almost $2,000 in the last year, and the monthly payment at $576, it is also at a record high. Bottom line is this, guys, you see this periodically, maybe every 3 or 4 years, Joe, where raw material costs move higher for the auto industry, but what they're seeing right now, they've never seen it happen this quickly.
Weird. And it's not just the way it used to be, where it'd be like big things like metal and all the components. Now, a lot of it is chips, sure. I guess. Probably a lot of it is chips.
No, you're talking about metal here. I mean, look,
metal
some of these steel mills, these steel mills had to shut down because of COVID-19.
So
that restricted supply a little bit. And then when you look at aluminum, Joe, it's not just run-of-the-mill aluminum. Highly specialized and a number of different varieties going into these vehicles, especially electric vehicles. That's driving up the cost as well.
What about internet? It hasn't lowered. Nobody goes to a dealership anymore, is it?
And look at the smirk at Phil LeBeau's face. I mean, what kind of dumb question is this? What about the internet? This Joe guy is the dumbest person I've ever seen in my life. Even a baby could do a better job hosting this show instead of this moron. What, are you going to print steel out of the internet? Continuing.
Isn't there a way of, are you seeing any?
Well, you're talking about you're talking about in terms of the sales process.
Overall.
Yeah.
Overall. It doesn't seem like cars have gone up that much, even with the raw material costs, because there's pressure.
I disagree, Joe. You look at the transaction prices right now. Transaction prices are almost $40,000 per vehicle. That's a record high. That's a new vehicle. You look on the used side, they're record high too. They're at over $20,000. So we are seeing this move higher.
Inflation adjusted, is it so it's significant?
It's still significant. I mean, I don't have the exact percentage when you do inflation adjusted, but there is no doubt. You talk with people in the auto industry, they will tell you they are feeling the pain right now in terms of raw material costs.
And here's for all of you inflation deniers. Aluminum prices surging higher, almost to the highs of the trade war. And you're seeing the impact right away in a stock like Alcoa, for example, up over 400% since the bottom of last year. What about iron? Surging higher to levels have not been seen since 2012. What about steel? Steel surging to surpass the trade war highs. What about EV components? Nickel surging higher to the highest levels ever. Cobalt almost doubling in price since the beginning of the year. Lithium, similar story, surging higher, almost doubling in price from just a few months ago. And what about rhodium? Rhodium exploding higher to all-time highs. And it's not just about auto manufacturers. What about regular goods? Regular spending that impacts me and you and the average American household. Lumber prices surging to all-time highs. Crude oil recapturing the pre-pandemic levels and surpassing them. And what about poultry? You like chicken? I like chicken. Well, I got bad news for you, because poultry prices surging higher to reach the highest levels in decades. What about beef? Beef trading higher. Matter of fact, more than tripling in price since 2012. But rest assured, if you are from the deflationary crowd who continue to deny inflation, you got an ally in the Federal Reserve. Because when presented with the data, the Federal Reserve says, la 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 la, I cannot hear you. I cannot see inflation anywhere. And they continue to deny. Example, we heard from St. Louis Fed President James Bullard. We've talked about this guy before in length. He is known to be a massive stoner and perhaps smoking too much hash and issuing stupid statements all over the place. He's been famous for doing that, and perhaps it was the reason behind removing him from being a voting member in the Federal Reserve. But rest assured that Jim Bullard continues to smoke the hash and issuing crazy statements. And by the way, this is not the hash that me and you smoke. This is the good stuff, the Federal Reserve hash. And I'm not sure whether the statements from Jim Bullard were done in an interview or a comedy club. Bullard, don't see Operation Twist as an option right now. Wait a minute, your job is to prop up the market, Mr. Bullard. Your job is not to spook the market by saying that Operation Twist is not an option right now. You should say that Operation Twist is an option and not the only option to prop up the stock market, Mr. Bullard. You see what I'm saying here? But perhaps the hash has gotten into you, and now you're being honest. Here is more from Jim Bullard. Bullard would be concerned by disorderly trading. We are not at that point right now, really. I mean, either he's doing a comedy routine right now, or that he's just not aware at all with what he's saying. But this is just a sample of what comes out of the stoner mouth of James Bullard. More jokes from Jim Bullard. Bullard would welcome inflation above 2% on a sustained basis. You know what that's going to do to bond yields, Mr. Bullshitter? How come nobody asked him that question? But if you thought that you heard enough of the craziness of James Bullard, wait, there is more. Bullard says only putting a 50% chance probability on an infrastructure bill. Bullard, commodity price jump doesn't equal sustained inflation. Of course, tell that to those who need to buy commodities. All of that report from Le Bleu about the car manufacturers struggling with commodity prices, apparently James Bullard does not see that as a problem. What inflation? What are you talking about? Let them eat lumber. And if you thought that Bullard is crazy, wait till you hear Kashkari, my favorite Fed personality. And of course, Neil is sort of like a man of the people. He has a Twitter account, and he'll go back and forth with you in the comments section. And then when he loses an argument, he goes on and complains about being bullied on Twitter. But perhaps we should be hopeful here that Neil Kashkari might at least recognize the problem at hand right here and not brush it off like Bullard did. Perhaps we can hear some more sanity from Kashkari's mouth versus James Bullard. Let's take a look. Fed's Kashkari, not concerned about inflation. I guess not. Here's more. Fed's Kashkari. Uptick in real yields would give me concern, could warrant policy response. But not seeing that. And of course, here is Sven Henrich calling the bullshit from Neil Kashkari. Can you ask him if rising yields are as much of an expression of confidence as low yields were last February? And of course, Kashkari, at the time when the market was crashing, he said that low treasury yields are an expression of confidence by investors. And now he's saying, oh, yields going higher is an expression of confidence by investors. Are you kidding me? They don't even pay attention to the bullshit that comes out of their mouth, the irony and the stupidity. Continuing with macro news. What about the trade deficit? Here it is. The U.S. trade deficit widens in January as goods imports hit a record high. The Commerce Department reports the deficit rose 1.9% to $68.2 billion versus the $67.5 billion economists had forecast. December deficit revised upward to $66.97 billion. So they cooked the books back in January, and now they revised the number to the real one when nobody's paying attention. Imports rose 1.2% to $260.2 billion. Meanwhile, exports rose 1% to $191 $1.9 billion. What does that mean? It means that the Chinese are kicking our asses, and they're about to kick us even more. China's spending on research and development to rise 7% per year in a push for major technology breakthroughs. Meanwhile, are our corporations doing the same by spending the cash in research and development? Of course not. So what are they spending the cash on? Here it is. Corporate buybacks, baby. Here it is. We're back, using all of the cash to buy back stocks and make corporate executives richer. So I don't know if you're laying a bet here. Who will win the technology war in the 21st century? The country that is spending on research and development, or the country that is spending on shares buybacks? And here is the last bit of macro news I got for you. And once again, it is a concerning sign for more and more inflation. Let's start with the good and then present the ugly. The good news: US and European Union to suspend tariffs in effort to resolve the Boeing-Airbus trade dispute. However, Trump's 232 tariffs on steel and aluminum have worked. Whoever that is said, the data show that those tariffs have been effective. The Biden administration will conduct a whole of government review of all of these policies and decide what it makes sense to maintain, meaning that the BlackRock administration likes the tariffs from the prior Goldman Sachs administration. And once again, we have all of these inflationary pressures. Add to that tariffs on top, and you have a perfect recipe for inflation to get out of hand. Moving on to the heat map analysis, let's see what happened throughout the week. As expected, the inflationary trade of energy, industrials, materials, financials, outperforming per usual. Likewise, we saw an outperformance from consumer defensives. But pay attention here. Remember that legendary investor Peter Lynch said, when there is a war, don't buy the stocks that are involved in the war. Buy the stocks that make the bullets instead. When you take a look at the consumer defensive sector of the market, the war under high inflation will be between Walmart, Costco, Target, Dollar General, etc. And you saw these names suffering tremendously. But who makes the bullets here? Procter & Gamble, Coca-Cola, PepsiCo, Mondelez. These are the names that will be able to pass the extra cost to the end customer. We also saw value names outperforming, whether we're talking about old school tech names such as IBM, Cisco, Oracle, or in the healthcare sector, Pfizer, United Health, Anthem, etc. Meanwhile, the bulk of the pain was in the momentum name, the high growth, high valuations type of names. Whether we're talking about software names, semiconductor names, Tesla, PayPal, Carvana, the biotech sector. But there is also another theme of rewarding Berkshire Hathaway. In times like these, perhaps investors are reminded with the success and the resiliency of Warren Buffett's style of investing. We saw Berkshire closing the week with about 5% gains, and names like Bank of America outperforming the rest of bank names and closing the week with over 6% gains. Likewise, another name in the Berkshire portfolio, American Express, closing the week with about 9% gains. Similar story for T-Mobile, closing the week with about 4% gains. General Motors with about 5% gains. Coca-Cola, over 3.5% gains. Mondelez, over 4.5%. Kroger, closing the week with about 7% gains. Chevron, 9% gains. Pretty much every name under the Berkshire Hathaway portfolio managed to outperform. So perhaps there's a theme here with following Berkshire's portfolio. Another thing to pay attention to is the outperformance from Google and Facebook. Google closing the week up over 3.7%, Facebook closing the week up over 2.5%. But we did not see massive declines for the big technology behemoth of Apple, Microsoft. Amazon was down about 3%, but yet again, that is outperforming other high multiple names. So the question is, are Google and Facebook trying to tell us something here, that perhaps the big technology names will rebound this upcoming week? I certainly believe so, specifically when you look at Apple's performance. I don't believe that the rebound is sustainable given the trajectory of higher yields, but at least we are due for a rebound. And what about the themes in this market, starting with the rotation trade? Are we still seeing this rotation going on from the stay-at-home to the reopening trade? You can say that, but I do believe that this theme is outdated. We saw massive declines for Peloton, Zoom, Zillow, DocuSign, Shopify, all of these stay-at-home names. But the picture is mixed when you take a look at the comeback stocks, the reopening stocks. You see gains in American Express, Six Flags, Cheesecake Factory, but we also saw declines in TJ Maxx, Planet Fitness, Marriott, Southwest, and therefore I believe that the rotation trade is not relevant anymore. What's relevant is the inflationary versus the deflationary trade. So let's take a look at those, starting with the inflationary trade. And by the way, I changed a few names here. The list is adopting with my observations in the market, but not a lot of significant changes here since you saw the list last time. Take a look at names in the financial sector of the market. JP Morgan Chase up over 2.5%. US Bank up almost 5% for the week, a name that I own in my portfolio and I recommend it for you. Big gains, whether we're talking about MasterCard, Mondelez, New Mount Gold, Waste Management, UPS, Boeing, Kroger, WestRock, up over 16% for the week. Unbelievable. Alcoa up over 18%. And what I'm hoping for here in the upcoming week is we see a rotation between the inflationary trade and the deflationary trade, meaning buying the dip in the beaten down deflationary names and taking profits from the inflationary names. And that would be an opportunity to buy, because the trajectory for the long term is that the inflationary names, value stocks will outperform. So I would love to see a sell-off here in these names to start to accumulate some of them in my portfolio. We're talking about Martin Marietta, Hubble, John Deere, UPS, Waste Management, CarMax. I'm interested in a lot of names here that I do not own in my portfolio. And I'm looking for an attractive entry point, and perhaps we will get that during this upcoming week. What about the deflationary trade? We saw some gains here in few names, such as General Motors, D.R. Horton, Duke Energy, Dollar Tree, even though Dollar Tree got whacked last week, and Dollar General got whacked this week. The point is that these dollar stores will not be able to compete under high inflation because their entire competitive advantage is the lower price. So passing the high input price, the increase in input prices to the end customer, is not a choice here for these dollar stores. They have to eat the cost, and therefore their margins will shrink lower. But we saw significant pain in names such as Snapchat, Okta down over 17%, DoorDash, Peloton down over 12%, DocuSign down over 9%. You get the picture. But what I'm seeing here is that these names got whacked severely and they are oversold and due for a rebound. However, the rebound will be an opportunity to short the rip. But don't be a donkey and do it right away on Monday. Let's say that these names open higher on Monday, gapping higher. Let the rebound run its course, and then look for reversal signals before placing a short. Likewise, I'm not going to be buying the dip in the inflationary names until the profit taking takes its course. And you'll be able to spot that right away on the charts. Speaking of, moving on to the charts analysis, starting with the SPY 30 minutes chart to illustrate to you the journey so far. We saw a series of bear flags pushing us lower, then we saw a head and shoulder formation, followed by a bear flag, and then we saw a bottoming formation of an ABC pattern that was followed by a head and shoulder formation that took us lower, and that was followed by another bottoming formation of an ABC pattern, and then we saw a head and shoulder formation once again that took us lower, and now on Friday we saw yet another bottoming ABC pattern. And the question is, where do we go from here? For that, we are switching to the 15 minutes chart, and let's clean up some of the markings here. What do we see? I see the resistance level of 386 and the support at 374. We have sort of a double bottom formation, and the mission here for the chart is to beat the resistance of 386 and turn it into support. And that could happen overnight, by the way, from any gap higher. What about the big picture? From a daily perspective, the continuous contract of the SPY. We have broken 3,862 and we have broken the trend line, but we managed to recapture it again on Friday. The challenge here for the continuous contract, and you'll be able to track that overnight, is to recapture 3,862. And that would be a very bullish signal for the S&P 500. The problem is, and once again, this is the theme of the contrast between the short term versus the longer term. The daily chart is open for a rebound on more bullish activities, but the weekly chart tells a different story. Here is the SPX from a weekly perspective. Take a look at how extended we are from a MACD perspective. We are due for a turn lower. We were about to do that last year during the September sell-off. But the momentum was so hot, and there was the elections optimism and the new administration. So that threw a new lifeline for the market to rally. The question is, will the new stimulus throw a new lifeline for the market to continue to rally higher? And even if that is the case, extending the music to play for longer will not change the inevitable. The chart is saying, at least from a weekly perspective, the turnaround is due and it's about to happen imminently. So do not be seduced by any push higher in the market from a day-to-day perspective, because the weekly picture is saying this rally is about to end. Similarly, when we move to the Qs, 30 minutes chart first, a series of bear flags pushing the charts lower, and then we saw the saucer bottoming, and that took us all the way to face the resistance. 323. We failed at that level, creating yet another bear flag, and that took us all the way to the very critical and important level of support of 313. And I told you then, if we break 313, the floodgates will open. And indeed they did. We saw the Qs flushing lower all the way to the levels of 299, capturing support from that level and now bouncing higher, closing slightly above the support level of 308.5. But the most important line of all of these lines that you see on the chart is the 313. So the mission here for the Qs is to bounce higher and recapture 313. That could happen overnight. That could happen due to an overnight gap. The question is, will it hold after the opening? And if we do indeed recapture 313, understand that the rally could go on for a few days at least to take us all the way to the yet very important level of 323. So what you should be watching for is the level of 313. Failing to recapture that level, reversing lower, that would be your signal to short the rip. What about the 15 minutes perspective? Cleaning up the chart, we've been seeing a series of lower lows. On Friday, things change, at least for that particular day, from a 15 minutes perspective. As small and narrow as this perspective may be, we are starting to see a series of higher lows. And once again, the biggest obstacle for the Qs to rally higher is the level of 313. That would be a very significant resistance, and the easiest way you can defeat that resistance is gapping higher above it overnight. We'll see if they do that or not. But for now, we're moving on to the daily chart of the continuous contract of the Qs. What do we see here? A rebound higher on Friday, but not closing above the highs of the prior day. Can you read anything here? Not really. You got two levels to watch for. 12,766, that is the resistance, and 12,408, that is your support. Let's say the futures open higher and we go above 12,766. Where is the next destination? Recapturing the purple trend line. And once again, after a massive sell-off, just like we witnessed the last couple of weeks, it is not out of the norm for the Nasdaq to rally impulsively, at least in the short term. But here is what I want to show you, the big picture. This is a weekly chart of the NDX, the big Nasdaq. When we use the Fibonacci date indicators over the chart, going all the way back to the March bottom of last year, you see how accurate the Fibonacci date range is, almost to the penny. Date range number 1 coincided with the September correction in the Nasdaq. Date number 2 coincided with the current correction we're facing right now. And we have a third date around August of this year. Now, let's combine that with the Fibonacci retracement range and see how far this correction can go. And once again, to the penny, we went all the way to the first range, and the challenge here is the following. Was that all there is? This is the correction that we got, and we're going to bounce higher. And if that is the case, then the range for the bounce could go all the way higher by 9% or so to reach the first resistance, which coincides with the top we marked in February. Now, what if the other scenario takes place? And this is just a dead cat bounce, and we will resume the flush down. The next destination will be 12% losses from where we closed on Friday. And that will take us down all the way to the levels of 11,163 or so. And you might be asking yourself, well, what is the point here? Because the indicator is giving us ranges, but it's not telling us if the market is going to go higher or lower. Well, nothing is going to tell you if the market is going to go higher or lower unless you have a crystal ball. But the point of watching the Fibonacci retracement lines is that you'll know right away watching the chart on Monday, on Tuesday, which trajectory are we heading to. Let's say that we start the week higher and we continue to go higher and higher, but we reverse before we challenge last week's, meaning this week, candles highs. In technical analysis, that qualifies as a reversal. And if that is a reversal, then you have targets to look forward to. And you'll know right away that we will breach the first line of support and we're going down to decline further, all the way to the next support that you see in the area shaded in green. Moving on to the IWM. What do we see here? Gapping higher in the morning, only to sell off violently before we saw the IWM along with other indices reversing higher. The dip was bought and you saw the V-shaped recovery intraday. But we did close at a very important resistance level, and that happens to be the level of 218. So it remains to be seen here whether the IWM will be successful in gapping higher and trading all the way to the trend line, or will it fail at the resistance of 218. And once again, if we are anticipating that we will see a rebound in the beaten down technology names in the Qs, that has to come on the expense of another sector of the market. And we know that the reopening names have been outperforming while the Qs were getting whacked. So it's not out of the norm to see the Qs outperforming the IWM this upcoming week. Matter of fact, it's not out of the norm if we see the IWM struggling to break above 218. Once again, there is this synchrony of the short-term rebound we saw on Friday, meaning that if we see a gap higher overnight, it will include all the indices, the IWM, no exception. But once again, the theme is to differentiate between the short-term outlook, in which we might see a rebound, and the longer-term picture. And for that, moving on to the daily picture of the IWM, what do we see here? The most important take is that we have broken the series of higher lows. And for now, the best case scenario for the IWM is consolidation sideways to build up some lost momentum. Will we just consolidate in the IWM while we see a rout in the rest of the market, specifically in the Qs, if yields continue to rise higher? I certainly don't think so. I think that the IWM has a lot of room downward before it becomes oversold, meaning that regardless of how big of a rebound we get, I will be looking downward for the support levels of 196.5, 191.5 as the destination from which the IWM will become oversold and perhaps have a sustainable rebound then. Moving on to the Dixie, we talked about the bull flag formation and the destination of 92. Well, we stopped at 91.97. We could not break above 92. Is this the resistance for the dollar index? And we will start to trade lower from this point on. Remember, the dollar index has been rising for two reasons. Number one, the safety of cash from the sell-off in the market. Number two, there has to be some background manipulation from the Federal Reserve to ease commodity prices by pushing the dollar index higher. That hasn't been working so far. It has been working in pushing gold prices lower, but it hasn't been working to curb the massive surge higher in crude oil prices, copper prices, grains prices, lumber prices. These are the most important inflationary commodities in the market right now. Therefore, if we do see buy the dip continuing during this upcoming week, specifically for the technology names, I expect the dollar index to dive lower. And what does that mean for gold, for example? Once again, we are eyeing the levels of 1,675 for potential support. It could rebound before that, but remember, gold has another headwind working against it, and that is Bitcoin. So let's take a look at the chart of Bitcoin and see what's going on. Once again, it is a series of higher highs and higher lows. Until this is negated with forming a lower low, the upward trend in Bitcoin remains on the table. Moving on to copper. And by the way, I issued this tweet for Freeport McMoran, and I said a lot of you asked me when to buy the dip in Freeport. The dollar looks like it's facing big resistance in 92, and copper prices are rebounding higher. And indeed, you saw a massive surge for copper futures. Meanwhile, the dollar index stopped short of the resistance line of 92. And that was the buying opportunity for Freeport-McMoran because the name was trading in the red briefly at some point during Friday's session, but it managed to bounce back along with everything. While I do not believe that the bounce in, say, the high multiple technology names or stock like Tesla as sustainable, I think that they're oversold and a bounce is due for a day, 2, 3, but then the bounce will be an opportunity to short because the problem for these technology names hasn't been solved. Yields continue to rise higher and higher, but the rebound in Freeport and copper in specific is perhaps more sustainable because it is supported by the rise of inflation expectations and higher yields. Moving on to the 10-year Treasury yield, the TNX. What do we see here? A massive pop higher right after the jobs report, but then we saw funny activities of pushing the 10-year Treasury yield lower. And that coincided with the bottom in the market on Friday, and the dip buying started, pushing the indices higher and the TNX to close well below the highs of the day. Once again, the inflationary pressures did not go anywhere. If anything, they're increasing by the day. Every single data we're receiving is supporting high inflation, meaning that the trajectory for the TNX is higher and higher until the Federal Reserve does something. Moving on to the VIX, going all the way to the resistance of 30.5, failing and coming back, breaching the support of 25. Once again, if we are expecting a rally, say in the Qs, will that be on the expense of a sell-off from the reopening names and from the hottest sectors of the market the last couple of weeks? Energy, financials, materials, industrials. If we see a sell-off in these sectors to take profits and rotate to the beaten down technology names, then the VIX will stabilize and become less volatile than we saw the last few weeks, because technology is a large component of the S&P 500. Remember that the VIX tracks the S&P 500, not the Qs, the Nasdaq. But technology is a large component of the S&P 500. If it catches a bid on the expense of industrials, materials, financials, energy, that would act as a stabilizing effect, and we will see the VIX stabilizing, perhaps a little lower. Moving on to Apple. What do we see here in Apple? Daily chart. Remember what I usually say, as Apple goes, so will the Nasdaq. And Apple was the leading indicator that a sell-off is imminent in the Nasdaq because it started to sell off way before we saw the sell-off in the entire Nasdaq. If we start to see Apple bottoming and rebounding higher, outperforming, that would be your leading indicator that the Nasdaq is also about to catch a bid and rally higher. We closed above the support of 120. The next challenge is 125, but if you want to be out of the woods completely here in Apple, you need to recapture 131. 131 to me is the most important number here to beat for Apple. Meaning, let's say that we see a huge rally in Apple, taking us all the way 127, 128, 129, and then before the week closes, we reverse and close below 131. That would be an ominous signal and perhaps an invitation to short the rip. Moving on to Tesla, the souffle. A daily chart, we talked about the importance of the level of 599. You can round that up to 600. Doesn't matter to me. I'm just showing you my number. We breached below that number, and at the end of the day, we managed to close right on the number. 597.95 was the close for Tesla. We're not going to make a big deal of the close below 599. But it is notable because I was watching the action live. Names like Apple, AMD, other beaten down names started to surge and rally higher. Tesla did as well. Off the lows, it was down over 12%, it closed well above that, but it also struggled to capture the same momentum as other names, as if the market is telling you that whatever bounce Tesla catches, it's not gonna last. And I certainly concur with this narrative, because looking at the daily chart from an RSI perspective, you are reaching very oversold conditions, and the name is due for a bounce. Now, switching to the weekly chart, different picture entirely. The name is not oversold, and it just started to trend negatively, at least from the MACD perspective, indicating more pain to come for Tesla. So we could see a rebound, a big one, but that would be a bull trap and an opportunity to short. You just have to wait. Don't hop on the short side right away. After massive declines, let the rebound run its course. And perhaps maybe you want to play the rebound and then look for the signal of exhaustion from the rebound and reversal. And that would be the point to place a short. Because once again, nothing has changed regarding the concerns that started the sell-off in Tesla, the rise in treasury yields. Nothing was solved there whatsoever. And perhaps the market wants to sell off even more to send a message to Jerome Powell. But knowing market technicals and market psychology, investors will be attracted to buying the dip, at least for the short term. Combine that with the fact that we have a lot of short covering, profit taking that has to take place, and you have a perfect formula for a rebound in the market, specifically in a beaten name such as Tesla. Moving on to the RKK for ARK Invest. And once again, when I started shorting this name, and I told you that my target is about 35% correction that would take us all the way to the trend line, I was made fun of. What are you, crazy? You think ARK Invest is going to go down? You're taking a lot of risk, etc., etc. Well, we're already there. We've reached the trend line, and you see very oversold conditions for RKK, at least from the daily perspective, indicating that the name is due for a rebound. But the problem is, and once again, this is a consistent theme of this video, differentiate between the short term versus the long term outlook. Short term, we're looking for a rebound. Long term, from a weekly chart perspective, the pain just started for RKK, and we could indeed breach below the yellow trend line that you see in the chart, because the MACD indicator is very extended, and when you get to a very extended territory in the MACD indicator and you start to turn lower and you make a successful crossing, creating red impressions in the histogram, there is a lot of pain to come here, a massive correction. So once again, please differentiate between the short term and the longer term. In the short term, a rebound is imminent. In the longer term, that rebound will be an opportunity to short. And how is yours truly that you're listening to right now playing the rebound? Here it is. I think Marvel experienced a lot of pain in a short amount of time. I'm buying calls to play a rebound in the name. The PEG ratio for Marvel is half a point, one of the best valued in the semiconductor sector. And I issued this tweet around 8:45 Pacific time. Let me show you the daily chart of Marvel first. From the top, the name dropped over 32% in a matter of days. That is a massive correction, and it was overdue for Marvel, to be honest. But now, a rebound was very due, because stocks are not going to go down in a straight line 32% in a few days without any rebounds whatsoever. Again, the name might continue to decline at some point if the correction morph into something bigger. But for now, playing a rebound is the right choice, because here is the 15 minutes chart, and I bought around 8:45, and the name rallied over 7% since I bought these calls. And by the way, these calls for Marvel appreciated over 100%, so I took half of those off the table, and I am playing with house money. And where is the destination, the target for the rebound for Marvel? We do have a gap all the way at the levels of around 45.5. If the rebound continues on Monday, perhaps Tuesday, and we get very close to 44, I will close the position. And here are the last few charts I want to show you to illustrate the point of the short term versus the long term, and reading the tea leaves of which sector of the market will be sold off and which sector will be bought. Starting with Roku, a daily chart. The name got sold off significantly, catching support from an important level and rebounding higher. I do expect Roku to continue to rebound higher in the short term. However, switching to the weekly chart, once again, take a look at the MACD. The pain just started for the name. It's been extended since last year, and it never made red impressions on the histogram of the MACD since last year. It is way overextended. And when you get overextended to these levels, the correction will be very violent. And in my opinion, it just started here for Roku. But it's not going to go in a straight line. Expect a rebound, consolidation, but the long-term outlook here is for a massive correction for this name. Now, let's contrast that with a reopening name, such as Carnival Cruises. Here's a daily chart, overextended, overbought, facing resistance, and due for a pullback. You see the MACD curling downward, and it is ready to start creating red impressions on the histogram, taking profits from Carnival Cruises and rotating those profits to buy the dip in Roku. Now, take a look at the weekly chart of CCL Carnival Cruises. Upward trend, we haven't reached oversold conditions at all. Very strong momentum, indicating that we could see pullbacks from a daily perspective, short-term perspective, but the long-term outlook here from the weekly chart perspective is higher. I think I did a good job here to illustrate to you the difference between the short-term and the longer term. Enough said. We're moving on to the conclusion of this video. What do we have in the economic calendar? On Wednesday, we have very important data regarding inflation, the Consumer Price Index, and the core CPI. And once again, if the market continues to sell off, then I'm assuming that these numbers will be cooked, trying to show us that inflation is not a problem at all, trying to manipulate yields lower. But the reason behind yields surging higher is the rise of commodity prices. Unless you can address that particular problem, yields will continue to rise higher. Regardless of the propaganda, regardless of the cooking, regardless of anything, we have an inflation problem, and the market is voicing its concerns loud and clear via the action in the bonds market. Thursday, we get the usual initial jobless claims, and then on Friday, we have yet another very important inflation indicator, the Producer Price Index. The rational expectations are that the CPI and the PPI will show increase in inflation, assuming that the numbers are not cooked. And if they are not cooked and we get a higher reading, then perhaps we will see a rebound in the stock market Monday, Tuesday, and then the data on Wednesday. If it comes out too hot, it would cause a reversal in the stock market. We will see yields surging back up higher and the stock market selling off. I am just trying to read the tea leaves for you. Anyways, this is a very long video. I don't intend to make it longer, so thank you for watching, and I hope that you got some good information from this video. I'll talk to you again on Monday.